As of February 2026, the global reserve structure has fractured. The data is no longer theoretical. China held $1.316 trillion in US Treasuries in November 2013. As of November 2025, that figure sits at $682.64 billion, a record low in the modern era. Most people believe China is trapped. The official narrative claims they cannot sell without destroying their own wealth. The headlines say they need the dollar. The math says otherwise. China has already offloaded $634 billion. Over half their peak holdings gone. They are not selling for profit. They are selling for sovereign survival. Today, I am breaking down the three-stage mechanism behind this exit. Stage 1, the liquidation velocity. Stage 2, the legal trapdoor opening June 3rd, 2026. Stage 3, the replacement infrastructure already being tested by 7 central banks. We are currently in Stage 1, a mandatory protocol before we open the file. This is not financial advice. I'm not a licensed advisor. The math follows a script, but your capital is your responsibility. Always conduct your own research. The common belief is that China cannot exit the Treasury market without triggering a collapse that destroys their remaining holdings. The logic sounds clean. If they dump, yields spike, bond prices crash, and their own portfolio implodes. You see, that argument assumes China still cares about maximizing return on their dollar reserves. They do not. The data shows a different priority: velocity over value. In 2024, China reduced Treasury holdings by approximately $68 billion. In 2025 alone, they dumped $115 billion. The acceleration is measurable. The monthly average in 2025 was $9.58 billion per month. In the final quarter, that average jumped to $11.2 billion per month, which means the selling is not random. It is systematic. Plus, the trajectory reveals intent. If China maintains this velocity through the first half of 2026, their holdings will fall below $600 billion by June. That is not portfolio management. That is an exit strategy. The mechanism is simple. China is converting dollar-denominated debt into hard assets and alternative reserve instruments. Gold reserves held by the People's Bank of China increased by 226 tons in 2023 and 2024 combined. That is the fastest accumulation rate since 2015. The timeline matters. November 2013 marked China's peak Treasury position at $1.316 trillion. That same year, the Federal Reserve began tapering quantitative easing. The script was written then. China saw the endgame. 12 years later, they have removed 48% of their exposure. The velocity is the fingerprint. Slow liquidation protects value. Rapid liquidation prioritizes escape. If this velocity mechanism just clicked for you, or you want to track these macro shifts as they happen in real time, join the Forensic Circle by hitting subscribe. Most people will ignore the June 3rd deadline and pay the price. We hold ourselves to a different standard here. Let me show you why that date matters. Because even this $634 billion liquidation is a distraction from the real trap hidden in the legal fine print. On June 3rd, 2026, a specific legal amendment goes live that fundamentally redefines what it means to own an electronic asset. And China is sprinting toward the exit before that door closes. June 3rd, 2026 is not a random date. On that day, New York State's amendments to the Uniform Commercial Code go live. Specifically, the adoption of UCC Article 12. This is not a policy tweak. This is a legal redefinition of ownership in the digital age. The law introduces a new category of property: controllable electronic records, CERs. Under UCC Section 12-105, control replaces possession as the determinant of legal ownership for electronic assets. The language is surgical. If you do not have exclusive power to transfer the asset, you do not own it. You hold an unsecured claim, which means your brokerage account, your digital dollars, your tokenized securities, none of it is yours under the traditional definition of property rights. You see, the current system operates on a custody model. You deposit money, the bank holds it, you assume you own it. UCC Article 12 formalizes what was already true in practice. The custodian controls the asset. You control a claim against the custodian. The distinction matters when the system fractures. In a crisis, claims are subordinated. Control is sovereign. Plus, this framework was not designed in isolation. It dovetails with a parallel infrastructure being built at the international level. The Bank for International Settlements launched Project Agora in April 2024. The participants include the Federal Reserve Bank of New York, the European Central Bank, the Bank of Japan, the Bank of Korea, the Bank of Mexico, the Swiss National Bank, and the Bank of England, 7 central banks. One unified ledger prototype. The objective, according to the BIS, is to test wholesale cross-border payments using tokenized commercial bank deposits on a programmable platform. The final report is scheduled for release in the first half of 2026. the same window as the UCC Article 12 deadline. The math is no longer theoretical. The legal framework for digital asset control goes live in New York. The technical infrastructure for a unified ledger is being stress tested by the world's reserve-issuing central banks, and the timeline converges in mid-2026. China sees the endgame. They are not exiting the treasury market because they believe the dollar will collapse tomorrow. They are exiting because the definition of ownership is being rewritten, and they refuse to be an unsecured creditor in a system they do not control. The mechanism is already in motion. Over $1.5 trillion in commercial real estate loans mature by the end of 2026. The majority of this debt sits on the balance sheets of regional and mid-tier banks. Refinancing is not optional. It is mandatory. The problem, refinancing is impossible for a significant percentage of these loans. Office vacancy rates in major metros hit 19% in 2025. The hybrid work model is structural, not cyclical. Demand for commercial office space has permanently contracted. Property values have fallen by 20 to 30% in key markets, which means the collateral backing these loans is now worth less than the outstanding debt. You see, a bank cannot refinance a loan if the loan-to-value ratio exceeds regulatory thresholds. The math does not work. The bank either forecloses, restructures at a loss, or holds the non-performing asset and takes a capital hit. None of these options preserve liquidity. The data shows the scale of the problem. According to the Mortgage Bankers Association, roughly $570 billion in commercial real estate debt matured in 2025. Another $930 billion matures in 2026. The refinancing rate for 2025 was approximately 62%. 38% of maturing loans either defaulted, were restructured, or were extended under distressed terms. If that ratio holds for 2026, you're looking at $350 billion in losses or non-performing assets hitting the banking sector within 12 months. Plus, the losses are not evenly distributed. Regional banks hold a disproportionate share of commercial real estate exposure. The top 25 largest banks hold roughly 30% of total CRE loans. The remaining 70% is scattered across 4,000 smaller institutions, which means the contagion risk is diffuse. One failure does not trigger a cascade. 50 failures do. The mechanism is a slow bleed, not a flash crash. But the endpoint is the same, a liquidity freeze in the regional banking sector. Now layer the two mechanisms together. China is liquidating $634 billion in treasury holdings. The velocity accelerated in 2025. The endpoint, if current trends hold, is late 2026. UCC Article 12 redefines legal ownership of electronic assets. The effective date is June 3rd, 2026. Project Agara's Unified Ledger Prototype Report is due in the first half of 2026. The commercial real estate maturity wall peaks in 2026, creating a liquidity crisis in the regional banking system. The convergence is mathematical. China is exiting before the legal framework changes, before the unified ledger goes operational, before the liquidity freeze forces the Federal Reserve to intervene with emergency measures that fundamentally alter the structure of dollar-denominated assets. You see, the moment the Fed steps in to backstop the regional banks, the game changes. Emergency liquidity comes with conditions. Those conditions include adoption of the new digital infrastructure, the infrastructure that runs on controllable electronic records, the infrastructure where control determines ownership, which means your claim against a failed bank becomes a claim against a system you do not control. China refuses to be on the wrong side of that transition. The timeline is not speculative, it is mechanical. The legal amendments are public. The BIS project is documented. The maturity wall is a matter of loan-level data. The only variable is whether you see the script before the curtain drops. But even this convergence is just the surface mechanism. The deeper pattern is historical. This is not the first time a reserve empire has executed a controlled demolition of its own currency. The British Empire ran the exact playbook in 1931. The timeline was different. The outcome was identical. And the wealth transfer that followed erased generational fortunes in less than 18 months. The law does not announce itself with headlines. UCC Article 12 applies to any asset that qualifies as a controllable electronic record. The definition is broad. Digital currency, tokenized securities, electronic payment rights. Anything that exists as a record on a digital ledger and can be transferred electronically. Which means if your wealth is stored in a brokerage account, a digital wallet, or a bank database, it falls under this framework. The key section is UCC 12-105, subsection A. It states, a person has control of a controllable electronic record if the controllable electronic record gives the person the power to avail itself of substantially all the benefit from the controllable electronic record, and the exclusive power to prevent others from availing themselves of substantially all the benefit. Read it again. Exclusive power. You see, when you deposit funds in a bank, you do not retain exclusive power. The bank has that power. When you hold securities in a brokerage, the depository trust company holds the exclusive power to transfer those shares. You hold a beneficial interest, not control. Under the old framework, that distinction was theoretical. Under UCC Article 12, it becomes legally determinative. In the event of a crisis, claims are settled based on a hierarchy. Secured creditors are paid first. Unsecured creditors are paid last, if at all. If you do not have control under UCC 12-105, you are an unsecured creditor. The math is brutal. In the Cyprus bail-in of 2013, depositors with accounts over 100,000 euros lost 47.5% of their balance overnight. Those depositors had a claim. They did not have control, which means the legal infrastructure for a similar event in the United States is now codified. Dodd-Frank Title II already allows for bail-ins. UCC Article 12 defines who owns what when the dust settles. Plus, the timing ensures maximum adoption. By mid-2026, the commercial real estate crisis will force multiple regional bank failures. The Federal Reserve will intervene. The intervention will include mandatory migration to the new digital payment rails, the rails that operate under the UCC Article 12 framework. You will not be given a choice, you will be given a timeline. China is not waiting for that timeline. The regulatory mechanism is already tightening. In July 2023, US regulators proposed the Basel Three Endgame framework. The objective, according to official statements, is to strengthen the banking system by increasing capital requirements for large institutions. The reality is a credit contraction disguised as prudence. Under the proposed rules, capital requirements for the largest banks increase by 16 to 19%. The Federal Reserve's own analysis estimates that each 1% increase in capital requirements reduces domestic economic output by $42 billion annually, which means if the full 19% increase is implemented, you are looking at a $798 billion reduction in annual GDP. You see, capital requirements determine how much a bank can lend. Higher requirements mean banks must hold more reserves against each loan. Fewer loans get approved. Credit becomes scarce. Economic activity slows. The timing is surgical. The Basel Three Endgame implementation window runs through 2027. The commercial real estate maturity wall peaks in 2026. The UCC Article 12 framework goes live in June 2026. The mechanisms are synchronized. Banks face a liquidity crisis from defaulting commercial real estate loans. Simultaneously, they are required to hold significantly more capital against their remaining assets. The math does not allow for both. Something breaks. Plus, the Basel framework includes a provision that treats unrealized losses on securities holdings as capital deductions. The majority of regional banks hold long-duration treasuries purchased in 2020 and 2021 when yields were near zero. Those bonds are now underwater. Yields spiked from 0.5% in 2021 to over 4.5% in 2023. Bond prices move inverse to yields. A treasury bond purchased at par in 2021 is now worth 70 to 80 cents on the dollar, which means banks are sitting on hundreds of billions in unrealized losses. Under Basel III, those losses reduce regulatory capital. Reduced capital limits, lending capacity, limited lending capacity triggers a deflationary spiral. The cycle is self-reinforcing. China sees the trap. They are exiting before the trap closes. This script has been performed before. In October 1929, the US stock market collapsed. The crash was not the cause of the Great Depression. It was the trigger for a liquidity freeze that followed. Banks held significant exposure to margin loans and speculative real estate. When asset prices collapsed, borrowers defaulted. Banks faced a wave of non-performing loans. Depositors, sensing instability, began withdrawing funds. The Federal Reserve, operating under the gold standard, could not print unlimited currency to backstop the system. Banks failed. Credit evaporated. The money supply contracted by 33% between 1929 and 1933. The mechanism was identical to what is forming now. Over-leveraged assets, a maturity wall, regulatory constraints that prevent liquidity expansion. The outcome was a decade-long depression. You see, the trap is structural, not cyclical. When a reserve currency empire transitions from a production economy to a debt refinancing economy, the endgame is mathematical. The British Empire executed the same pattern. In the early 1900s, Britain was the global reserve issuer. The pound sterling financed international trade. British banks held the majority of global sovereign debt. By 1931, the system fractured. Britain could no longer maintain the gold peg. On September 20th, 1931, the UK abandoned the gold standard. The pound devalued by 25% overnight. Holders of sterling-denominated debt were erased. The transition from reserve dominance to reserve collapse took less than 30 years. The US is following the identical trajectory. The dollar's share of global reserves was 72% in 2000. By 2025, that figure fell to 56%. The term for this is structural erosion. It is not a sudden crash. It is a slow mechanical loss of confidence in the currency's ability to preserve value across time. Plus, the erosion accelerates once a critical threshold is breached. For the British pound, that threshold was the loss of production capacity. Britain stopped making goods and started managing debt. The same transition is visible in U.S. economic data. In 1950, manufacturing represented 28% of U.S. GDP. By 2025, that figure sits below 11%. The economy is now 77% services. The majority of those services are financial intermediation and debt management, which means the U.S. economy no longer produces enough real goods to service its obligations without devaluing the currency. The math is identical to Rome in the 3rd century. The empire debased the denarius from 95% silver to less than 5% silver over a 70-year span. The debasement funded military expansion and social programs. The currency collapsed. The empire fractured. The mechanism is always the same. Empires do not collapse from external invasion. They collapse from internal currency debasement and the loss of productive capacity. The legal framework is already in place. Under Dodd-Frank Title II, enacted in 2010, your bank deposit is classified as an unsecured liability in the event of a bank failure. You are not a customer, you are a creditor. The language is specific. Section 210 of Dodd-Frank allows the Federal Deposit Insurance Corporation to execute a bail-in. In a bail-in, the bank's liabilities are converted to equity or written down to recapitalize the institution. Your deposit is a liability on the bank's balance sheet, which means in a systemic crisis, your account balance can be reduced to absorb the bank's losses. This is not theoretical. It was executed in Cyprus in 2013. Depositors with accounts over 100,000 euros lost 47.5% overnight. The legal precedent exists. The regulatory authority exists. The only missing variable is the crisis trigger. The commercial real estate maturity wall provides that trigger. You see, the FDIC insurance limit is $250,000 per depositor per institution. The FDIC's Deposit Insurance Fund held approximately $128 billion as of the end of 2025. Total insured deposits in the U.S. banking system exceed $9.6 trillion. The coverage ratio is 1.3%. If more than 1.3% of insured deposits are simultaneously at risk, the fund is insolvent. At that point, the FDIC either requests a Treasury backstop or executes bail-ins to preserve systemic stability. The math dictates the outcome. Your deposits are only as secure as the institution holding them. And that institution is about to face a $1.5 trillion wave of defaulting commercial real estate debt while simultaneously being forced to raise capital requirements by 16 to 19%. Plus, under UCC Article 12, your legal claim to those deposits is redefined. You do not hold control. You hold a beneficial interest subordinate to the custodian's control rights, which means in a crisis, you are last in line. China is not last in line. They are out of the line entirely. But even this legal and historical framework is incomplete without understanding the replacement system China is building, because they are not liquidating $634 billion and holding cash. They are converting dollar exposure into a parallel infrastructure that bypasses the UCC Article 12 trap entirely. And that infrastructure goes operational in the exact same window as the crisis. Most people will ignore the June 3rd deadline and pay the price. They will wait for the headlines to confirm what the data already shows. By then, the legal framework will be operational, the unified ledger will be live, and their claim to their own wealth will be subordinate to a system they do not control. If you refuse to be a victim of the script, subscribe. We hold ourselves to a different standard here. This is the forensic circle. People who read the fine print before the trap closes, people who understand that the math does not care about exceptionalism or official narratives. Plus, the June 3rd deadline is not the only mechanism in play. UCC Article 8 has already redefined stock ownership. You do not legally own the shares in your brokerage account. You own a security entitlement against the depository trust company, which means in a systemic failure, you are an unsecured creditor with a claim, not an owner with control. I am writing a full autopsy on that mechanism right now. Make sure you are subscribed so you do not miss the reveal when it drops. The timeline is converging. Project Agara's prototype report releases in the first half of 2026, the same window as the $1.5 trillion commercial real estate maturity wall, the same window as UCC Article 12 goes live. China has already removed $634 billion from the system. The velocity is accelerating. The pattern is historical. The outcome is mathematical. The math does not lie. Only the headlines do.